The mystery of money. Where does it come from? Money. We use it every day. It's such an integral part of our lives that we often take it for granted. We earn it, spend it, save it, and sometimes even dream about it. But have you ever stopped to think about its origins? But where does it come from? This question might seem simple, but the answer is far from straightforward. It's not like apples on a tree, right? We can't just walk into a garden and pick dollar bills off branches. We can't just pluck it from a branch. The creation of money is a fascinating process that involves a complex interplay of economics, politics, and technology. The creation of money is a fascinating process. It starts at places like mints and central banks where physical currency is printed and coins are minted, but that's just the tip of the iceberg. It's a bit of a mystery, even to some. Many people don't realize that most of the money in circulation today isn't physical at all. It's digital, existing only as numbers in bank accounts. But it doesn't have to be. Think about it. The concept of money has evolved over thousands of years, from bartering goods and services to using precious metals, and finally to the paper and digital currencies we use today. We use money to buy things. This exchange of money for goods and services is the foundation of our economy. We earn money by working. Our labor and skills are exchanged for this medium of value, which we then use to fulfill our needs and desires. But how did this whole system begin? The history of money is a tale of human ingenuity and adaptation. Early civilizations used barter systems, trading goods directly. But as societies grew, the need for a more efficient system became apparent. Who decided that these pieces of paper or these digital numbers have value? The answer lies in a collective agreement. Money works because we all agree to accept it in exchange for goods and services. This trust is the cornerstone of our financial system. Let's unravel this enigma together. By understanding the origins and evolution of money, we can better appreciate its role in our lives and the economy. So join us as we delve deeper into the fascinating world of money creation and discover the secrets behind this everyday mystery. Every country or group of countries needs a guardian for its money. This guardian ensures that the financial system remains stable and that the economy can grow without overheating or falling into recession. This guardian is the central bank. Central banks are pivotal institutions in the financial world, tasked with a variety of responsibilities that go beyond just managing the currency. In the United States, it's the Federal Reserve, often called the Fed. The Fed is one of the most influential central banks globally, setting policies that can impact not just the US economy, but also the global financial markets. Think of the central bank as the conductor of an orchestra. Just as a conductor ensures that each musician plays their part harmoniously, the central bank ensures that different sectors of the economy work together smoothly. The orchestra is the economy. Each instrument represents a different aspect of the economy, from businesses and consumers to investors and government entities. The conductor makes sure everything is in sync. By adjusting interest rates, regulating banks, and providing financial services, the central bank keeps the economy on track. The central bank doesn't print money all the time. That's a common misconception. While they do have the authority to issue currency, their primary focus is on maintaining monetary stability. Their role is far more nuanced. They set interest rates, control inflation, and act as a lender of last resort to banks in times of financial distress. They control the flow of money. By buying and selling government securities, they can influence the amount of money circulating in the economy. Too much and you get inflation. Inflation erodes the purchasing power of money, making goods and services more expensive over time. Too little and the economy can stagnate. It's a delicate balance. The central bank must carefully monitor economic indicators and adjust its policies to foster sustainable growth. The central bank also plays a crucial role in maintaining financial stability. By overseeing and regulating financial institutions, they help prevent financial crises. In today's digital age, central banks are also exploring the potential of digital currencies. These could revolutionize the way we think about money and payments. Central banks around the world work together to address global financial challenges. Through international cooperation, they aim to create a more stable and prosperous global economy. The guardians of money are constantly adapting to new economic realities. Their mission is to ensure that the financial system remains robust and that the economy can thrive in an ever-changing world. Understanding the role of central banks helps us appreciate the complex mechanisms that keep our economies running smoothly. They are the unsung heroes of the financial world, working behind the scenes to safeguard our economic future. Yes, central banks can print money, but this is just one tool in their toolbox, and it's not used as often as you might think. Printing money is like adding more water to a swimming pool. If you add too much, it overflows and causes problems. Printing money is usually a last resort. It's done to stimulate a struggling economy or to deal with extreme circumstances. The real magic of money creation happens elsewhere. Commercial banks are where the real action is. These are the banks we interact with every day. We deposit our paychecks, we take out loans, we use our debit cards. These everyday transactions are at the heart of money creation. Here's the key. Banks don't just hold on to all the money we deposit, they only keep a fraction of it in reserve. The rest, they lend it out to other customers. This lending is what creates new money. Section 5. The magic of loans creating money out of thin air. This concept might sound like something out of a fantasy novel, but it's a fundamental aspect of modern banking and finance. Imagine you deposit $1,000 into your bank account. This simple action sets off a chain reaction in the financial system. The bank is required to keep a certain percentage, say 10%, as reserves. This is a safety measure to ensure they have enough cash on hand for withdrawals. That means they hold on to $100. This reserve is a small fraction of your deposit, but it plays a crucial role in the banking system. The remaining $900, this is where the magic happens. They can lend it out to someone else. This process is known as fractional reserve banking. Let's say another customer takes out a loan for that $900. They might use it to buy a car, start a business, or pay for education. That $900 is now new money in the economy. It didn't exist before the loan was made. Remember, your original $1,000 is still in your account. Both amounts exist simultaneously. This dual existence is a cornerstone of how banks operate. This is how money is created through lending. The process can repeat multiple times, with each new loan creating more money. For instance, the person who borrowed $900 might deposit it into their bank account. Their bank will then keep 10% or $90 as reserves and lend out the remaining $810. This cycle can continue, with each new deposit and loan creating additional money. The initial $1,000 can multiply many times over, significantly increasing the money supply. This mechanism is essential for economic growth. It allows for more spending, investment, and overall economic activity. However, this system also comes with risks. If too much money is created too quickly, it can lead to inflation, where the value of money decreases and prices for goods and services rise. To manage these risks, central banks regulate the amount of money that can be created. They set reserve requirements and use other tools to control the money supply. The goal is to maintain financial stability while supporting economic growth. It's a delicate balance that requires constant monitoring and adjustment. In summary, creating money out of thin air is a fascinating and complex process. It involves a series of loans and deposits, each building on the last, to expand the money supply and fuel the economy. Understanding this process helps us appreciate the intricate workings of our financial system and the importance of responsible banking practices. This concludes our chapter on the magic of loans and the creation of money out of thin air. Stay tuned for more insights into the world of finance. Section 6. A real-world example, from loan to latte. Let's follow that $900 loan. Imagine the borrower uses it to buy a used car. The car seller then deposits the $900 into their own bank account. That bank, following the same rules, keeps 10%, $90, and lends out the rest, $810. That $810 is then spent, deposited again, and loaned out again. This cycle continues, with each loan creating more new money. The initial $1,000 deposit has now multiplied, fueling economic activity. There's Section 7, the money multiplier ripples in the pond. This process of lending, spending, and redepositing is called the money multiplier. It's like ripples in a pond. The initial loan creates a ripple effect, expanding the total amount of money in circulation. The size of the multiplier depends on how much banks are required to keep in reserve. A lower reserve requirement means more money can be lent out, creating a larger multiplier effect. Section 8, Inflation and Deflation, the ups and downs of money. Money creation isn't always a smooth ride. Too much money in circulation can lead to inflation. This is when prices rise and the value of money decreases. Remember the swimming pool analogy? On the other hand, too little money can stifle economic growth. This can lead to deflation, where prices fall. Finding the right balance is the central bank's perpetual challenge. Section 9. Money in our lives. From groceries to global trade, money plays a crucial role. Money is the lifeblood of our modern economy. It facilitates transactions, both large and small. From buying groceries to investing in the stock market, money is the intermediary. Money also enables global trade and commerce. Different countries use different currencies, but exchange rates allow us to buy and sell goods and services across borders seamlessly. And Section 10, the power and responsibility of money creation. Money creation is a powerful force. It can fuel economic growth, but it also carries risks. Understanding how money is created is essential for making informed decisions. Central banks and commercial banks play crucial roles in this process. Their actions have a direct impact on our daily lives. The next time you use money, take a moment to appreciate the invisible hand that brought it into existence.